Welcome to today's quick lesson on risk management, also known as insurance. Risk management can be very confusing or mysterious, but when you know the basics, you'll know how to protect the things that you've worked hard for. Assets like your computer, your house, your car, or an education that you might have paid for. Today we'll be talking about how to protect these things from too much risk. We'll learn the what, the why, and how of insurance, including terms like insurance premiums and liability coverage, as well as types of insurance like auto, life, renters, or homeowners. Here's an example of how insurance can work. Did you know that some celebrities insure their body parts? For example, David Beckham, who is a famous soccer athlete, insures his legs for $195 million. That means that Mr. Beckham pays a nice, shiny premium for an insurance policy that protects against the risk that his legs, which are essential for his career, are compromised somehow. Maybe his legs break during a soccer game. His legs are covered for $195 million to cover the cost of his treatment and recovery. You can find this, other helpful activities, and a full rundown about risk management and insurance on our free downloadable resource guide, which you can find on our website at www.financialbeginnings.org/materials. One component to know about when it comes to insurance is risk. You're buying an insurance policy to protect you against risk, which is defined as exposure to injury or loss. We expose ourselves to risk almost every day. One great example of this is driving. When each of us drives on the road, we're risking getting into a car accident and getting hurt. Insurance helps us manage risks like this by having us pay a small amount each month, in other words, a premium. This premium is paid to an insurance provider that will cover a much larger amount should something like an injury or loss happen. Here are some stats on the likelihood of the ultimate risk, death. Though our emotions may be more inclined to fear being eaten by a shark, which is 1 in 60,000, or getting to a plane crash, which is 1 in 5,000, the stats are heavily weighted towards everyday risks like driving, which is 1 in 84. Since we face risk every day, we must weigh the amount of risk we face so we can best determine how to manage it. Insurance can be a tool to help us manage the financial loss associated with risk. Things to ask yourself about it. How much would I lose financially if I were to get hurt in a car accident or if I hurt someone else? How much would it cost to insure against this loss, and where can I fit it into my budget? What is the likelihood of loss? Am I willing to accept the risk? Will it provide me peace of mind to have this coverage? So how does insurance work? Let's take the example of auto insurance. You as a car owner pay into a pool of money alongside your fellow car owners. This is called risk pooling. You select an insurance policy that covers different types of risks you need. You pay a premium, or in other words, the amount you pay the insurance company to have insurance. Finally, liability is what's included in your insurance policy to cover costs when you cause damage to others, like when you're at fault in a car accident. Here's a list of the most common type of insurance: auto, homeowners, renters, health, life, and disability. I'll be going over each in detail. First up is auto insurance. Drivers are required by law to carry what we call liability coverage. The government wants to make sure that others are protected if you cause damage to them or their property and are unable to pay for the damage yourself. Page 4 of the downloadable resource guide provides detailed explanations for each of these terms. In general, all drivers are required, again by law, to have insurance that covers general liability. Bodily injury per person includes all the medical bills, wage loss, and the amount for pain and suffering. Bodily injury per accident means that if there are several people who are injured, they might not get the per person max because all injuries combined are maxed at $50,000. If you get into an accident with a brand new BMW, how far is your property damage limit going to go? Purchasing car insurance can be complicated. There is coverage you're required by law to purchase and those that are purely optional. What's required by law in most states? General liability, again, which protects others against your negligence. Also required is uninsured motorist coverage, which provides protection if you're caused damage by an uninsured driver. Collision and comprehensive coverage are not required by law, but if you're financing your vehicle, the finance company will likely require these. Collision provides coverage for the insured's vehicle when in a collision, and comprehensive provides coverage for the insured's vehicle in the event of non-collision damages, like theft or a chipped windshield. Some states require personal injury protection, which covers medical expenses and lost wages, so it's important to know what your state requires. If someone is unable to pay you for damage they caused to your vehicle, it is best to first file a claim on their insurance policy. Comprehensive and collision are no-fault coverages, which means whether you're at fault or not, you can get your car fixed under these coverages. Before insurance can jump in to help pay to fix your car, you must first pay what's called a deductible, which is the amount of money you're obligated to pay out of pocket. It's important to understand that the higher your deductible, the lower your premium. Remember, your premium is the payment you make for your insurance. This is because you're willing to accept more responsibility for your own loss. It's important to think about how much you're willing to pay for your own damages and get a deductible that matches. Here's an example. The insurance policy you choose requires a $500 deductible. Say you get into an accident with $700 in damages. How much do you pay to help cover the damage? $500, which is your deductible. How much does the insurance pay? $200. What determines your premium? Remember, that's the rate you pay to have insurance. For example, that could be $100 per month. Each of these factors you see on this slide helps determine what your insurance rate should be for auto insurance. There's a whole set of algorithms that can measure the probability of risk. Here's an example. 35-year-old Patricia drives a 2018 Ford Fiesta, has had no major car accidents or violations, and lives in traffic-jammed San Francisco. What characteristic just raised her premium? Her zip code. Certain zip codes are tagged by insurance companies according to whether it has a high probability of risk, like car accidents. Her premium would be even more if Patricia had a couple of car accidents prior. Keep these in mind when you're ready to buy insurance. The main thing to remember is that auto insurance protects your savings if you get into an accident, and the money you owe is much more than the money you have. You will have paid that small monthly premium, so the insurance company will cover the cost of the car damage and bodily injuries if there are any. That protects you from having to empty your bank account or take out loans to pay for the accident. Next up on our insurance journey, renter's insurance. It basically asks the question, how much money is everything in your house worth? Let's set an example. Jose just bought an expensive memory foam mattress. He and his partner each have Mac laptops, and his mom gave him a few family heirloom jewels. When thinking about this in terms of insurance, ask, how much would it cost to replace these items? On average, it costs about $25,000 to replace items in a 2-bedroom apartment. 2/3 of renters do not have renter's insurance. Many renters believe that if something happens, their landlord's policy will cover their belongings, but this is not true. If the rental burns down, the landlord's policy will only cover the landlord's belongings. The cost of renter's insurance is very minimal. Also, if you get renter's insurance from the insurance carrier that covers your car, you'll likely get a discount. How does the insurance company know what you have? You take inventory of everything valuable in your home. It's important not to overlook this step because otherwise the insurance company may not believe that you have that 60-inch state-of-the-art TV. When you gather your inventory, it's important that you know where a safe place to store the records is, like a safety deposit box, a fire safe box, or on the cloud. Whenever you're ready to get renter's insurance, you can use page 10 of the downloadable resource guide to start your home inventory. Now let's look at homeowners insurance. What will happen if you burn down the kitchen or if someone trips walking down your stairs and needs surgery? Homeowners insurance provides liability protection, which covers you when you're at fault for damages to someone else while they're interacting with your home somehow. For example, you're covered when your dog bites the mailman and the mailman must get 10 stitches. After that claim, though, the insurance company may exclude your dog and not cover you if he bites anyone in the future. Now let's talk health insurance. Starting in 2019, the law no longer requires you to have health insurance, and there'll be no tax penalty if you don't have it. Even though health insurance is no longer mandatory, it's still smart to get covered. With healthcare costs so high these days, it's no surprise that medical bills are the largest cause of bankruptcy. Many health insurance policies have a deductible, just like with auto insurance. The deductible is the amount you're responsible for paying before the insurance company will begin to pay. Co-payments are common for health insurance policies. A co-payment is the portion of a claim or medical expense that members of a health plan must pay out of pocket. For example, a visit to your primary doctor might cost you $30 in co-payment. Many health insurance policies will cover the cost of preventative care, such as screenings for blood pressure, depression, and diabetes. It's much less expensive to prevent an illness than it is to treat one. When you're ready to buy health insurance, you can use page 12 of the downloadable resource guide to compare health insurance policies. Life insurance protects your family in case you die. Not everyone needs life insurance, but it's important to know when you do. When you have kids, yes to life insurance. When you're retired, no, you don't need life insurance. Single, no kids, no need. There are life insurance policies that only pay out upon death, and those are called term policies. There are some insurance policies that accrue savings, and those are called whole life. Term life insurance is the least expensive. Disability insurance covers a portion of your income while you're unable to work due to a disability. Short-term disability replaces a portion of your income for a few months. An example of this is when a woman goes on maternity leave, or if a dentist injures her hand and is unable to work for a few months. Some employers provide this coverage. If yours doesn't, you should find a policy on your own. Long-term disability replaces a portion of your income indefinitely if you become disabled. When you're in early adulthood, you're much more likely to become injured and disabled than you are to die. Still, many people overlook disability coverage. The cost is more expensive than life insurance because it's more likely to be used. But the cost of disability insurance can be lessened if you extend the time before the insurance starts to pay after becoming disabled and lowering percentage of your income that you have the insurance supplement. Disability insurance pays you a portion of your income if you're unable to work and is a very smart way to protect against risk. To summarize, here are the major takeaways from this presentation. Ensure you have the appropriate auto insurance. You'll put yourself in a difficult and expensive situation if you're underinsured. Homeowners or renters insurance. Protect your valuable belongings and protect your money against having to pay up after things like a natural disaster or robbery. Health insurance. This is a no-brainer since healthcare costs are very high. Remember, medical bills are the number one reason for bankruptcy. Know when you need life insurance. You may not need it now, but think of the time when you will, like when you get married or have kids. Last but not least, especially if you're young, disability insurance is very important to protect your income if you get injured or are too sick to work. Thank you so much for listening. For additional information, look to your resource guide for all things insurance.